So, to kind of kick things off, so again, I want to say thank you guys for, jumping on because really, this is the time where you have the opportunity to ask away on anything that you want. This is your time. Tomorrow, 4 o'clock Central is more regimented training. We're going to talk about some services in regards to, um, you know, like some people have used NetLaw in the past for wills and trusts. We have some strategic relationships that can offer more than just that. So when you talk about advanced estate planning, special needs trusts, irrevocable trust, things like that, we have someone who can help with that stuff and then some. So we're going to talk about that tomorrow. But again, that's more your regimented training, sales ideas, product, process and stuff like that. So this is more open forum. So really, it's up to you guys what you want to talk about. Now, Vipul had me on a call 2 days ago, and I think it was yesterday. So he grilled me on wanting to talk about IULs and the benefits of IULs, when you use them, how you use them, what they are, kind of like a history, if you will, of that, which is totally fine. I have no problem doing that. We also have illustration design, things like that for IULs if you guys want to see some of that stuff. So before I jump into one, thing for, um, all parties considered, I just want to take a quick survey. Does anyone else have anything that they want to talk about as well? Are they along the same line as that, or what? Just let me know real quick if that makes sense, or if there's something else you want to see too. Good. Oh, thumbs up. Okay. So I just had to find my pen here to see if I want to doodle a little bit because I always love that. Okay, well, we'll kind of kickstart with that. It's a good way to kind of move forward through the process. And what I would say is that as we look at the story of how the IUL works, again, the idea behind it, but also really, from the standpoint of, what type of clientele would need this type of solution. We'll just kind of go through some of the nuts and bolts there, and then ultimately, really, there's some cool things that I'll kind of share real quick with you guys today on stuff I'm working on, actually for the summit here that's going to be September 13th and 14th here in Nashville. So there's still some spots left if anyone wants to come. I'm just not paying for rooms. But nonetheless, when we talk about like the idea of the IUL, um, I'll share here my little doodle screen action. Everyone can see that okay? Okay. So, really in regards to permanent insurance, like a lot of people, when they look at permanent insurance, because a lot of times when you talk to a client, what are they going to say? They're going to say, "Oh, I just want whole life," and everyone's like, whole life, So what we want to ask people is, when you talk about this, are you talking about the actual product whole life, or are you talking about permanent insurance, right? Because permanent insurance really got divided up into traditional whole life, and then you have the UL chassis. So the whole life product, again, is not a bad product. I'd highly recommend if you did not see the training on whole life. I broke it down pretty extensively on one of our Thursdays. Um, and so, like, as we talk about that, some of the benefits being like guarantees. So, guaranteed is the big thing here, guaranteed cash value, guaranteed death benefit, and also guaranteed premiums. So, the UL kind of separated its segments and strategies, so to speak, in a different manner, and it broke up into subsections. Like there's the current assumption UL, there is the GUL, there is the VUL, and then there is IUL. Okay, so all of these have different flavors of what whole life brought to the table, but they're less costly because in all of these scenarios, there is some onus on the customer. Okay. So current assumption UL, all of these are flexible, right? So flexible products versus what this is very rigid. Okay. Um, and it doesn't mean that rigid, I don't want to say rigid as a context is a bad thing. What I say is with rigid is there's a set premium structure, and if you miss it, then you're going to take a loan out against it, things like that. So, as they built off of the chassis or the idea of whole life, they took pieces of it and segmented it into different parts of what you see in the UL. Like you have cash value growth. Yes, it's guaranteed, but you also have the dividends. Dividends are dictated by the insurance company to give to the consumer. So current assumption UL has a fixed interest rate to give you cash value, but that is designed by the insurance company and they have the right to raise it or lower it. Okay. So basically, what happened with the dot-com bubble burst, you saw a lot of companies with those fixed interest rates just drop their rates. It went down to like 2008 as well. You saw a lot of people just drop their rates. So what happened was GUL became very popular. GUL is basically like a perm term. That's really all it is. You pay a premium, you get a death benefit, it's guaranteed. Cash value really it doesn't matter in that. The cash value belongs to the secondary guarantees. So it's not really a product designed for an exit strategy, if you will. For the most part, all the cash value is eaten up by guarantees. But the problem is that if you miss a premium, you are in the situation where it could take your guarantees, say from 105 to like 95. So there's some situations there where GUL can have that rigid type of feel to it, but it does give you a guaranteed death benefit. So it took a different category of what whole life gives you and gives you just that by itself. So once again, you see there's pieces of it compared to the whole thing. VUL just took advantage of the market. So you don't have a fixed rate, you have a variable growth rate, and you don't see as many of these sold because you need a FINRA license. So with that, you need to, talk about mutual funds that you're basically putting them into. There's different fund accounts that they have. So American Funds, Franklin Templeton, PIMCO, and other major money management accounts are actually in these VULs. These resonate very well with financial advisors and RIAs because of the fact that it has that money management type of feature to it. So it speaks in their wheelhouse. VULs have evolved a little bit. There's some guaranteed VULs out there, but they're not widely as sold as, say, whole life or IULs because IULs, once again, is kind of a combination of all three of these to a certain extent, put into you have, variable growth, but you have a floor. It is capped growth, so you don't get the type of growth you could get with a VUL. And ultimately, there's pros and cons to all of them. So again, tailoring the factor to this to understand where IULs came from before we kind of dive into how to position them, how to understand them a little better, and what type of clientele are they meant for. I wanted to at least give you that quick history of where they came from. And IULs have changed a lot over the last 10 years. So I remember when I would do policy reviews with when I was at MetLife, and someone was talking about an IUL, and the illustration rate was 14 or 16%. That was the illustration rate. So when you sit there and you say, my God, you can't beat this. Someone puts in 10 grand for 10 years and then is pulling out $1 million in cash value for the rest of their lives. Absolutely ridiculous. So the idea of where it originally came from, I was not a big fan of them. So I moved over from, MetLife, whole life company with VULs too, to working with IULs and GULs. And I'm sitting here going like, IULs are terrible, blah, blah, blah. But then as I got to know them, but more importantly, as the insurance regulators got to regulate them through three different approaches, it has mitigated the interest rates or the illustration rates, I should say, which can temper the expectation, which can help you as a producer speak in more confidence, in my opinion. Now, some carriers try and circumvent all of that with their volatility controlled indexes. So, I'm taking a big stance on saying I usually illustrate all of mine at the S&P, or if some carriers like Symetra has the Nasdaq, I like to see that as well, because they've been around a very long time, great track record, as opposed to these volatility controlled indexes that, they show a back testing of 20 years that look fantastic, and then when it's actually in practice, it's like, and it drops like a lead balloon. So, so that's again just some things. I call it my philosophy from that standpoint, understanding how to really dive into the product to understand it better. So my whole objective anytime is to make sure I don't get sued, and I want to make sure you guys don't get sued either. So that's why I like to go in a little bit more in depth with this, because in the wrong hands, we see certain things happen, and then from there it just escalates. So we'll kind of move forward here and we'll talk about, what I would say from a standpoint of, um, that's a good question, Penny. So is anyone still writing current assumption ULs or GULs? That's what I'm assuming when you said guts, but yeah. So Columbus still has a GUL. Um, I think Columbus also has a current assumption UL, but I'll just say few and far between. They're not really designed to be um, anything major. Americo, I think, and or Foresters had a GUL for a while, but you'd see them often run through multi-level marketing companies, and it was like the cat's meow. But Anico did for a while too, but now Anico only sells annuities. So the GULs, the problem with it is they're so expensive from a reserve standpoint and from a cost standpoint in general. The illustrations or the products themselves have been in such a low interest rate environment for so long in the insurance industry that it became not profitable for them to actually keep on the books. So they started to tear them away. And what happened was, because the IUL is right here, they had cash value IULs, which everyone loves talking about. And then they have death benefit IULs, which not a lot of people talk about, but I find those to be the better solution of the two anyway, because it still falls in line with the functionality of life insurance, and it actually is a lower cost than the cash value ones, but you also have less participation rate and things like that too. So trade-offs for everything. Downside for the producer, less target on the DB focused versus the accumulation products. They usually have higher targets. So, Subhash, you had a question?
Yeah, I had a question, Phil. Thank you for the opportunity. So, Phil, my question was in a whole life, when that's also a cash value um, um, system, and when there is dividends against the whole life, uh, are the dividends used to go to a cash value account, or is it used to buy additional death benefit for the insurer? Because I've noticed in some policies that the dividends go to the death benefit and not to the cash value, unlike like IUL and other plans,
Well, they do. So what it is so like we'll say that whole life is over here and you have a flat face amount of whole life. Well, dividends are taken in certain ways. There's paid up additions. You could put it in a different accumulation bucket that they offer. You could take it as cash. So you could do several things. So the dividend is actually a partial refund of your premium that they're giving back. But what people 99% of the time do dividends or reduce their premium payments. Those are usually the two that they do. But anytime you add a dividend in, it's like a growing death benefit. But all those paid up additions, understanding the terminology, paid up additions is paid up pieces of insurance or paid up whole life, and inside paid up whole life, there's also guaranteed cash growth. So the dividends give you paid up additions with little incremental cash pieces in it. So, like, oftentimes you'll see, like, on a ledger, so if this is a whole life ledger, they have a line there and there's a guaranteed side, and then there's a non guaranteed side. And on the non guaranteed side has the dividends. And you can see the difference between the guaranteed cash value and the non guaranteed cash value is basically the dividends adding into it. So it's really, it does add to both, but again, what I've said before, and I'll say again, is when people don't have that product in their format or their system, they typically tend to bash it and not look at it for what it's really worth, because whole life is a great policy for some people. An IUL is a great policy for some people, but it is not great for everybody. That's why in our dynamic in our world, we have the best of both worlds because the guys at Three Mark said it the best. They're like, I keep a diversified portfolio for a reason, because if one carrier changes their mind on any product, you're dead in the water. So they specifically diversify their approach. A lot of times the reasons why a lot of people came to Valor in the first place is because they knew me as the RVP for AIG. And so I could talk very well about the quality of life product. Hell, I still sell a lot of it, but it's not my end all be all because it's not going to fit every carrier. So yes, whole life, to kind of get off my soapbox and back to what you asked, whole life does carry cash value inside of the paid up additions. So when you take cash, though, it's like you're lopping off part of those paid up additions. Okay. So it goes through that first. And then if you took all of those paid up additions cash, then you revert into taking loans against the base cash value. So I always like to tell people not to say that cash value thing doesn't belong to you story, because the cash does belong to you while you're alive. You can use it, but at death, it's part of the death benefit. That's the same thing with IULs. So it's like, I hate hearing when people are like, oh, the cash doesn't belong to you. If you take loans, it never belongs to you. You're borrowing the carrier's money. So, any way you shake it, it's the same thing. So I like to, again, try and strip away terminology that might have been with other organizations, because it's really a myth, but they use it to sell because they don't have the other product, so they're going to bash the other product. Go ahead,
Phil,
Vipul.
Phil, question. Uh, I think my understanding, but again, not to name names, it's a cash value never belonged to, but I was informed that in a whole life, especially New York whole life, cash value doesn't belong to you when and at the time of death benefit, it doesn't even get it added to the death benefit. If your policy is let's for 100,000, then you at death, if something happens, then you only get paid 100,000, not 100,000 plus 10,000 cash value.
Well, I mean, you could look at an IUL ledger, it's the same thing. So if you have it increasing, it's the cash value plus the death benefit. But if you're doing an income sale and you levelize the death benefit to give you more cash growth, that level death benefit is the death benefit at death. So it's all relative, as you look at it. So some people they'll try and spin a story to say that their product is better. When I was wholesaling to the company that you're probably thinking of, there was a time where, and this is how dumb it can be when it boils down to it, and sadly, it's the ignorance of the customer. Someone compared whole life to as a Tesla and IULs as a Honda. And he literally said to the guy, like, we gave all these bullet holes to, it was a Guardian policy. I like whole life. I don't like Guardian policies. No offense to anyone who likes them. Just, I don't like them compared to like Mass, New York, Northwestern. Those usually have the better whole lives, in my opinion. But, the guy literally said to the guy, he's like, would you rather drive a Tesla or would you rather drive a Honda? And the guy kept the whole life. I was like, all sense and sensibility got thrown out the window because people have stupid sales tactics to try and keep their clients into these products, or they use those same sales tactics to try and move them to other products. And so, like, I just did a policy review today for someone who had a Mutual of Omaha policy, was designed completely wrong, but the client still had $9,000 in surrender charges on a $46,000, cash value. And so I said to the guy, I was like, he has no surrender charges in 10 years. His premium is only $3,600. It's like 1% of his take home. Just keep paying that, and then you have a guaranteed ROP at year 20, or you'll have all that cash and then some in 15 years when the surrender schedule is over. So there's no problem in saying someone has a good policy. Matter of fact, it probably gives you better credibility than trying to use a deceitful phrase to lure it away, if you know what I mean. So that's
So
my
Phil,
personal opinion.
in what uh, scenarios would whole life would be better? Because I understand what whole life does,
Mhm.
but still, in
Um,
what scenario? But is it's still a whole life policy? IUL is also a whole life policy.
no, they're both permanent policies.
Government policy,
See,
yes. Okay.
see. So, so whole life is good in several scenarios, okay? So when you think about the idea of um, guarantees. So if you're talking a death benefit solution, you want a top shelf policy, you pay the premium, it's going to keep growing, cash is going to keep growing, death benefit will always be higher next year than it was this year. That's a good story. Um, you also have the people who do the infinite banking. So infinite banking, IULs don't carry as much cash value, disposable cash value in the beginning, say 5 years, than you could get from a whole life. So if you have someone who is looking to put the money in, take a
Hmm.
loan out, put it into a double digit investment that they're going to get a return on quickly, and then put it back in, that's a great
Yeah.
story for them. Think realtors, real estate development kind of people, stuff like that. But the idea is the money is going back into it. You're not just taking it out and keeping it.
So it's
Um,
good for people who are not looking, who are looking for a short-term perspective with a view that I can take the money out from my policy and then pay it back.
yeah, think of like a bank. You're acting like your own bank. And so instead of you paying the bank to borrow money and giving them the interest, you're borrowing your own money and you're paying it back with the interest going back into your account. So you're growing your cash value. So that's the idea behind that. And so um, remember that all life insurance is really designed for long term. It's not designed for short term but the infinite banking concept isn't designed for a for an IUL product, plain and simple. But a lot of people will say, "Oh well, Columbus has an early cash value rider, so it can work the same." It can and it can't because you have a lot of volatility and fluctuation with the market. So a lot of time, like I saw one guy even said to me, he's like, "Oh yeah, well throw all the money in and then pay your credit card bills and then you never have to pay it back." I'm like, why don't you just pay your credit card bills and then buy an IUL separately? It's like you're trying to add all these things in to make it more complex, and it just doesn't have to be that way. Um, and I think customers will see through that more often than not. Go ahead, Tia. You're gonna say something?
Yes, from the customer's perspective, what does the taking a loan against or taking the cash value out of the policy look like? Like when do they mess it up?
All the time.
And what is the best way for them to actually use their cash value? Does
Yeah.
that make sense?
Yeah. So, like in that scenario, for example's sake, so say you've got a policy, you got a like 100K dump in, and then the annual premium is like 5 grand. Okay. So this 100K dump in is not going towards a, remember we talked about the base policy, right? It's
Mm-hmm.
going towards buying paid up additions. So you're really using this 100K to go in this space, not the base policy space. So from that standpoint, what's happening is now it's not impacting as much for this lower, smaller premium that's due. And so this person can say, take out a loan of, let's just say 75K. All right. And
Mm-hmm.
typical carriers will have anywhere from 5 to 8%, fixed loan rates. So if I can take this 75K, put it into an investment, and, I joke because there's quite a few Indians on this call who love real estate. And tell me if I'm wrong. Okay. But if they put 75K into a property and then flipped it in 3 months, they make more on their return. So say they get 125K, well, the 75K then goes back in here along with that interest that you paid going back to you. So you're actually gaining your own interest back as opposed to I'm Phil Resch going to Bank of America, borrowing 75K from them. They're charging me
Mm-hmm.
6% and they're getting the 6% and I'm paying them back.
Gotcha.
So that's the idea. So it's short-term stuff, not like I'm never going to pay it back kind of scenarios.
Okay. Okay.
Okay. So does that help?
Yeah. That's just yeah. It's when they don't pay it back.
Just like anything.
Yeah.
So, and I always,
And then
I always joke with people, I'm like, well, communism is great in theory, but when you put it in practice, human practice, something doesn't seem to work. So, same thing here. That's why anytime you have a cash play story, it's so sensitive in how you sell it because there's a lot of emotion to it. There's a lot of charges inside of insurance. And if you mess it up,
mhm,
then the customer gets pissed. And whether you're right, wrong, or indifferent, they're going to see you differently. And then there's a problem. So
right.
that's why, again, going back to what I said earlier, I like these sales more than the cash value sales. One, higher targets. Two, it serves the purpose of death benefit and legacy. And three, it's hard to mess up. So again, difference of opinions, but cash value is easier to talk about because everyone wants to know what they're going to get.
Okay. And so with the IUL
Mhm.
and its flexibility, what
Yep.
happens there? Is
So
it
great
similar
question.
or
Yeah, with IULs, like if you try and put 100K in the first year and then 5K after, it's gonna be a bit harder in my opinion because unless you're doing like term riders and other things, because what's gonna happen is over here you have that flexibility in between of those paid up edition riders. Over here, you don't. You're just gonna have to find a bigger death benefit to stuff that 100K in. So
Mhm.
either a couple things, like I would break down this 100K and do it over a 5 pay, or even more a 10 pay to stretch it out. Because then instead of your death benefit being up here, your death benefit's down here, and you're not paying as much in interest on a higher death benefit. So right off the bat, my personal favorite idea or concept with the IULs is you really don't want to touch it for like the first 10 years, personally speaking. Um, and so what they have though, the differences is that you usually have a fixed note, you have your fixed, but then you also have a variable or an index which can be, anywhere from 5 to 8%, depending on the carrier. But if the cash value, like if you opt not to pay it back and you have a 3% return on that money, well now let's say it's 5%, you have a negative 2% note rate, you know, if it's a 10% return and the cap was 10%, now you have a positive 5%. So there are perks to the IUL from that standpoint with more aggressive potential upside. So that also leads to a little less predictability compared to the other side. So once again, in the short term, the whole life makes a lot more sense, especially from a predictability standpoint too, versus the IUL where you don't know what the market is going to do. So that's where you could run into some confusion or concern.
Gotcha. Gotcha.
So,
Okay.
all right. Richard, you had a question?
Yeah, like with the IULs and people say, a good question for me is like the QOL or whatever. Is it? Do you see like 10 years? Have you seen 10 years worth of proof where it has held what we've illustrated? I know Michael's a big whole life guy. You hear so many bad things about IUL, but you see so many good things, and you teach
Yep.
us to illustrate at 6%. So, have you seen honestly like one that's been in force for 10 to 12 years that's built up this cash value and so this LERP
Yep.
like we had sold, and that's just an honest question that I would like to know.
Yep. I have clients who I took over their policies
Hmm.
from 2018. So you're looking at, 7, almost 8 years. And the with the quality of life, the S&Ps have held true. The MLSB and the PIMCO have not, I'll be honest. The old block, if you will, the original Max Accum, the MLSB is at 70% and the PIMCO is at 60% as opposed to 180 or 175. So the MLSB is probably the biggest disappointment in my opinion. And I never really personally liked it in the first place. That's why again the S&P it's dropped to a whopping 9.5%. So the old blocks of business usually revolved around 10. So that hasn't changed much at all. And again, if you're running a projection around 6.5%, you're still in the ballpark. So you're going to hit more often than not. It's the best way to put it.
Do you still believe in the three in this, or just using two?
I'm focusing more solely on just the S&P. I
Okay,
still have my boys in the three, but it's
okay.
60 in the S&P, 20 in MLSB, and 20 in PIMCO. Because right now the indexes are still up at about 175, 175, not 175. So I'm okay keeping it where it's at. But if I see a dramatic drop, then I'm gonna switch it quickly to just 100% S&P.
Thank you.
Yep. Yep. Great questions. Um, I know we kind of dovetailed on a little bit of the kind of a comparison between whole and IUL. Hopefully this was helpful. So what I'm going to do real quick, so let's talk about target markets. So TM, okay. When you think about strategies here, and we'll look at, age demographics for cash value life insurance, is once again, I don't want to segment and just say IUL because it could be whole life too. So with cash value life insurance, you want to look for people who have six-figure incomes. Why do I say that? Because the same reason why that Mutual of Omaha policy was designed poorly. Someone advised them that this is like a Roth on steroids, but they were only putting $3,600 into it. I'm like, you could easily, and we can do Roths through National Life Group. So there's no fees to that, and the client can have growth like an IUL and tax-free income. So the six-figure income means that they are fully funding other vehicles, or they have a strong portfolio to invest, and then they have the ability to put money into an alternative like a LIRP, life insurance retirement plan, things like that. So six figures, the age bracket I want to say is somewhere between 30 to 55. You might have some bell curves in there. So you think about people who are in their late 20s who just got it all together, right? Um, if you have someone in their late 50s or 60s, it's not that this is off the table. It's just they have to understand the power of compounding. So if they want to start at 60, but then take income at 65, this is not the play. Okay. But if they want to fund from 60 to 70, and then have a backstop against loss of income or outliving their income, and then having it start at 80 to 95, something like that, that might be okay, but you still have to fund like 20, 30, 40, $50,000 for it to even make sense. So that's why I say 30 to 55 is a sweet spot really for cash value life insurance sales, where the gross will meet the grief, I guess you'd say. Um, and then, as anything, you have good health. So if you got someone who's got like a 8.0 A1C, probably not the way to go. I'll just be honest. Because they're probably going to get table D as in dog. All your stuff is going to get eaten up by cost of insurance, your cash value, so it's not worth it. So that's usually kind of like your target market for the cash value life insurance type sales. On the flip side, you have DB sales, okay? And that can be broken down into a couple spots. So there's traditional just DB, there's DB with LTC, and there's legacy, okay? Which can also be estate planning. So death benefit by itself, this can be anything from just, you could even say 30 to 80, really, because if you have someone who doesn't believe in term insurance, they can afford permanent and they want to, by all means, go with God, but this is going to be your more cost-efficient option, 30s to 80s. The face amounts can go all the way down to 50K, so it really doesn't have to be a six-figure earner to do this if they want some type of permanent, but also just kind of keep in mind the total need. So total need is higher than give them term insurance with good conversion privileges. Um, DB with long-term care, so you're talking about somewhere between 50 to 80. Someone who is, good at retirement, so they've got their retirement all set. Because on the flip side is the biggest killer to anyone's retirement is long-term care, not being able to use, or not being able to live the way they want to because now they're bedridden. And they have to overpay for things like that. So, a good question you can ask people 50 to 80, you can even stretch this to 45. Mr. and Mrs. Client, can you lift your spouse out of bed? Can they lift you out of bed? So, if there was some type of issue, what's your plan? Again, thought-provoking questions to help them get to where they need to be. Then estate and legacy planning. So you're talking either high net worth for like extreme estate planning, leveraging trusts and things like that. Legacy, that could be your grandparents kind of sale. So if I said to my parents, hey, Steve, Karen, if you wanted to leave a better legacy to, Cameron, Gavin, Cooper, Blake, and list all the grandkids. Would you be interested? That's a legacy. Do they want to leave something to the next generation or the generation after so that they know when they're gone, they're remembered? So that's where you're looking at people who are probably in their 60s to 80s, from that standpoint, have their retirement all squared away. There's scenarios where you can do an annuity funded life, where if someone has never assets that's sitting in an account and they want to leave a legacy to their kids, well, annuities are great, but they're going to be taxed. So just take an income stream and then put it into a life insurance policy, which will be tax free. So now you get the sale on the annuity, you get the sale on the life, but now the customer has no thought process because the income that they're not even touching is going to go and pay for the policy that they're wanting to leave for their legacy anyway. So that's kind of a scenario as to where you would see all these different kind of line items fall from a permanent insurance standpoint. And then really after that, it's about case design. How do you design the right product and the right fit? Um, you know, Vipul, I know this was a lot of your questions that you asked me to go over tonight. I don't want to start on the actual case design or illustration stuff today because that would take up another hour easily. But in regards to your initial questions, does this help from a prospecting standpoint?
Yes, it does. I think I'm still a little bit confused. Like, why would I take an annuity out if I can put it in an IUL, which will help me to take tax free? And annuity might be good for somebody who's like 60 plus, cannot leave the policy for 15, 20 years. But if I'm like in 40s and 30s, annuity is not the right product. I would just take, I'm thinking like we just put 25 years, put in an IUL, then you can take a tax free income.
And you're absolutely right, but I wasn't talking about that. What I was talking about is, let's say you have a 60-year-old couple, right? And they are living off of Social Security. They've got a pension or a 401k, whatever, and they're making more than enough to live on. They're living comfortably. Well, they have an IRA sitting over here with, let's say, 250K in it, and they're not touching it. They don't need to touch it. They don't care to use it. What would you do with this? Okay. So I understand a 30-year-old and a 40-year-old makes no sense to do that because, yeah, you could do the IUL. But in this scenario, could I reposition, let's say 250K for 60-year-olds will give me an income stream guaranteed for the rest of my life. Let's just say 6% of 250K. Hey Siri, what's 6% of 250K? I'm lazy.
6% times 250 is 15.
So $15,000 a year. Okay. So now you sub out taxes because this is a taxable account. So let's just say they have 12K net. 12K net can buy you a second to die if you wanted a second to die, or you could buy two single life IULs with LTC riders. So the
Okay.
idea is we're finding the money to help supplement, to help them not have to spend additional money. If we can uncover an asset that will help them pay for another asset that they need, then we've done our job right. And it may
But
not even be the
what
full
if you
250K.
have, but what if you have 40-year-old
having $200,000, $300,000 in their IRA.
Then that's the wrong conversation. So if someone, first off, if someone has it in their IRA, if you took that money out, now you're going to get a 10% penalty. So even pulling the money out from an IRA, first off, if a 30-year-old has 300,000 in their IRA, they're doing okay, and that would go back
Mhm.
up to here to say they're probably a six-figure income earner, and they probably
Mhm.
have enough money separately that they could put into an IUL. But you would not want to try this strategy for someone who's in their accumulation phase because it's not
Mhm.
designed for that. So, that would be an annuity, or we can do alternative investments because alternative investments can take qualified funds, and you can do that too. But it's all situational based on the customer. If they're
Mhm.
45, you might want to do a 5, 7 year annuity till they get to 50, and then you can get them into income annuity that'll grow to give them guaranteed income at 65. So it, it that's why I say, like, all of this stuff very situational. And for someone like you who's newer in the industry ish, it's this is all hypothetical, but when it comes to brass tacks, when you actually sit down with the client, you're
Mhm.
gonna always run into different situations. And so to have these strategies and solutions to think on the fly is going to be the most advantageous thing for you. But, I'll say it now and I'll say it to everybody here. You don't have to know it all, but you know someone who does. And I've
Mhm.
done, case splits and opportunities with people to help them all, get to where they need to be. So the big thing is that you're not in this alone. You never are. That's why we're here doing these meetings and stuff like this to help with stuff like that. But um, if you're talking someone younger demographic and they have qualified funds, you really have two avenues. You have a, annuity or alternative investments, because you don't want them to get taxes on that asset as well as a 10% penalty. It's not worth it. So that's
Uh,
personal opinion.
So there are alternative investment for younger demographics who has lumps of money in their IRA to do something different than annuity.
You invested in it. You can do the same thing with those companies. So yeah, it's
Okay.
those, they could take qualified funds. So yeah, absolutely. So um any other questions?
Phil, I'm assuming that most of these companies like Corebridge, like all of this, they probably have built a kind of different customer profiles, demographics like young, old.
Nope. They don't.
No,
They
they don't.
used
Okay.
to, but it brought liability
Hmm.
because if you segment, it's almost like you're, you know, picky choosy. So what these are all stories that, I've picked up over the years that I've worked with, that I've learned. And what I'll share is like, part of what we're gonna look at for those who are coming to the summit is a playbook that I'm working on, to help provide people with the right strategies and the right fits, for the right products. So it's going to talk about different sales ideas for different types of, strategies and things like that. So, you know, not saying, I'm just saying, if you're coming for the summit, you'll get this little bad boy, who knows, I may even print it out and spiral bound it. Who knows? So stuff like this, Vipul, will help as a playbook for you to kind of elevate your game, so to speak. But these are all stuff that, and I can't stress this enough. And unfortunately, Alan left. He wanted to find out how to operate like an independent insurance business. All of these things, is taught. It's like the student becomes the master, then the master, creates their own agency, and we support still, but you kind of learn as you go. Unfortunately, you're going to learn on some other clients as you go, but you get better. And so I always encourage people, especially people who um, are more afraid to talk to people. They're worried to talk to people because they think they're going to mess up. My first wholesaler, when I was at MetLife, literally said, "I want you to mess up because when you mess up, you won't do it again." And he was right. So as I continued down the path, as they always say, you cut your teeth, you lick your wounds, you do whatever. But as you continue to get out there and someone gives you something that they're like, "No, we're not going to do this," then you pull back, you rebuttal. And then someone says, "I'm not going to do that." And then you pull back and you rebuttal and you learn as you go. But the hardest part is when people don't get off the sideline and try and actually prospect because they're worried they're going to say the wrong thing, then you're actually hurting yourself more than you're helping. Someone who actually starts and knows 50% is going to do better than someone who wants to know 100% and doesn't do a thing. So, I would say that that's just the way this industry works. Everyone's looking for that magic bullet, the magic script that they'll have ready when someone says something, and you're like, "Oh, hold on, let me flip to page 22." No, it just doesn't work that way. So, so yeah, and we'll kind of dive into stuff like that. Again, in regards to like the summit, in regards to other things, we'll continue down that path of just kind of refining. But this is a an industry where like I forget the stat. It's like you hit a 250 in baseball and you're in the Hall of Fame. So, with us, if you hit like 1% in a lot of situations, you're doing great. But you got to get out there and get all your no's before you get to your yes. So that's, I guess you'd say the word of encouragement from this standpoint is that all this stuff, like you're just going to learn it as you go. And that's just the best way to do it.
Yep. Well, thanks, Phil.
No problem. Anyone have any last question, comment, raw burst of emotion?
So, Phil, I had a last question here, regarding college savings plan. So, when we kind of advertise ourselves, in terms of product deliverables, we always say college savings plans, right? So, would IUL be the best associated product when you reach out because of the cash value for young families to save up money through IUL for, kids growing up? And what would be the ideal time uh, at the age of a kid, to invest in these kind of plans,
8 or
I mean, I know
less.
it depends on the amount of premium you put and the the more amount you're paying above the cost of insurance that adds. But it's just a generic question,
Yep, age 8 or
Yeah.
less. Because once
Yeah.
you get over that, then you're fighting very minimal growth by the time they get
Okay.
in or get out of college. So if someone's like, "Well, I can only do $100," I'd be like, just put it into a 529 at that point, because if
Okay.
they don't use it, then they can move it to a Roth because it won't be much. So, understanding certain cultures value higher education more than others, they will go to extensive bounds to put higher premiums in for younger kids, like 10, 15, $20,000. So we just have to figure out the right carrier that can take that and if they're at the right age. Now, a simple trick of the trade, the whole idea of using an IUL versus a 529 is you're allowing the opportunity for grants and scholarships. Well, if you take out the income at 18 for them to use it right off at college, then there's no point because you're not getting grants or scholarships. Take advantage of the no interest money you can borrow from Uncle Sam if you can. And then on the back end, pay it off so you have time for the money to compound and grow inside the IUL. So I don't show income until about age 22 to 25. So I wouldn't pay it off all in 1 year. I'd pay it off over a 4 year time frame. So you let it continue to compound and grow and refuel itself. So that's a quick little hint for the 529s. But if it's any time after age 8, it's going to be hard pressed to say yes. Even myself as a customer, I would feel greasy trying to tell someone to buy it, if they're 10 years old and only putting $100 in a month. So that's just personal opinion.
Thank you.
So, kind of hit time, 9:01. I'm gonna drop now because it is my wife's birthday, and she was nice enough to let me come here to talk to you guys tonight. So, no, I felt guilty too, not, doing the last couple weeks. So, that being said, we have our training tomorrow. It is going to talk about different types of will and trust packages that you can offer to your customer. You can make money off of it, and it can help you grow your sales even bigger and better. So be on for that, and it is not net law, okay? So we've got some great opportunities. Thank you, Subash. So see you tomorrow. Just a pre-advance. Come the latter part of this month, I am heading out of country, so the 24th of September to October 12th. So that is going to be 3 Wednesdays and Thursdays in a row. So I'll have my handy dandy phone, text messages, things like that, but just err on the side of caution. There probably won't be trainings from that standpoint. I appreciate the well wishes. Preeti, you're going to say something?
Yeah, there won't be any phone calls, emails, Zoom calls.
No Zooms, maybe phone calls. WhatsApp.
Email.
I do have WhatsApp. It's the same number as my cell, so you can use the WhatsApp. I'll be as responsive as possible, but going with my dad, so trying to check out,
I
see the
know.
world.
Yep.
So
Enjoy.
I will. Thank you.
How long are
Rosanna, you
you?
guys say
How long you're gone?
from September 24th to October 12th.
Oh, okay.
Yep. So I'll put in the newsletter too, so you guys will see it. But I'll be around again. My WhatsApp is the same as my cell, so you can use that too. So thank you guys. Really, really appreciate it. You guys have a great rest of your night, and we'll see you tomorrow, 4 o'clock Central. Talk soon.
Good night.
Thanks, Val.